Hello and welcome to Investor's Edge. In this video, we're going to explore covered call writing. What is it, and how you can best execute this strategy in your portfolio. In our previous video titled, What is an Option?, we examined the payoff from purchasing a call option. If you remember, as a call option buyer, you enter the contract and pay a premium for the right to buy a stock at the designated strike price until expiry. Now, we're going to take a look at the other side of the trade from the perspective of the call option seller or writer. This is where we receive a premium upfront in exchange for the obligation to sell shares of the underlying company should the call be exercised. So what is a covered call? This is a strategy where we combine ownership of a stock with selling or writing a call against it. In other words, long stock, short calls. We either have shares of the company already, or we go out and purchase the shares in the market, generally prior to writing the calls. Imagine you own 500 shares of XYZ Inc. in your portfolio. You've been holding this stock for a while and have been looking for ways of generating additional income. In this case, you may choose to sell 5 XYZ Inc. calls at your selected strike price and expiry date. If the call option is exercised, you will have to sell your 500 shares. Now, what would happen if you owned 575 shares? Would you be able to write more than 5 calls? Since each option contract represents 100 shares, you must round down to the nearest 100 to figure out how many contracts you can actually write. In this example, the 75 shares is considered an odd lot, so you can only write calls against 500 shares or sell 5 contracts. As a covered call writer, what's in it for you? For starters, income is generated immediately, and you may use this cash flow for other investments to help fund your retirement or perhaps contribute to your next vacation. Secondly, it provides some downside protection by reducing the break-even value on the trade. Lastly, you may turn a profit without any increase in the underlying stock price. While you may buy back your calls at any point throughout the term of the contract, covered calls tend to be held until expiration. The reason why? Because as the option seller, time is on your side. If you recall from our previous video, there are 2 components of an option premium: intrinsic value and time value. Time value is the portion that generates profits for you, and we know time value rose to 0 at an accelerating rate. If we hold till expiration, we will either be assigned on our contracts and have to sell our shares, or the option expires worthless and we get to do it all over again. Now let's take a look at an example. Here we buy 1,000 shares of company XYZ for $12 a share. We sell 10 of the $13 calls that will expire in 6 months at a price of $1 per contract. We have positive cash flow of $1,000 from writing the call, which adds to the $12,000 outflow for purchasing the stock, thus reducing our break-even value on the trade to $11,000. What will happen next? Well, let's look at some scenarios. We bought our stock at $12 and sold our call for $1. What happens if the stock is up a lot during that 6-month period and closes at $18? You can see that you would have been much better off not writing the call, as the stock is up 50% compared to your maximum return, which is just shy of 17%. Why is that your maximum return? Remember, if the shares are trading above the strike price at expiry, you will be assigned on the calls and are obligated to sell the stock for $13. There is a $1 appreciation on the shares from 12 to 13, plus the dollar premium we collected. In this scenario, the opportunity cost of using the covered call strategy versus simply holding the stock is quite significant. The optimal outcome for us is if the stock closes at $13 on expiry, because we get to maximize the price appreciation potential of the trade without having to sell our shares. That appreciation is in addition to the premium we collected. Now, if the stock does not move and closes at this $12 price we purchased it at, the return generated is equal to the cash flow yield from the premium. If the stock is down a little, you may still turn a profit because, as we mentioned earlier, the premium lowers the break-even price on the trade. This highlights the downside protection component of the strategy, but it won't save you from a significant downward move in the stock price. From these scenarios, you can see the sweet spot for a covered call writer is slightly positive to flat stock performance. We mentioned earlier that on expiry, the contract will either be assigned or expire worthless. But is there another alternative? Let's take a look at 3 scenarios here. The call you wrote is in the money, and on expiry, you'll be assigned and sell your shares at the strike price. Number 2, if the stock is in the money but you do not want to sell your shares, you may close out your option position and sell a new contract with a future expiry. So here you have an outflow of cash to buy back the option, and then you have an inflow from the new contract that you're writing. We call this rolling out. You may also close out the contract and choose not to roll it over if you think there is strong upside potential for the stock. However, you may be paying more to close out that contract that you initially received when you wrote it. Number 3, what happens if the option expires worthless? Well, then you continue owning the shares and you may choose to write a new contract and start the cycle all over again. So how do we select which strike we choose? With any strike, there is a trade-off between capital appreciation potential for the stock and income generated. In-the-money options have the highest premiums, and the deeper you get in the money, the lower the time value there is. Overall, this offers the greatest downside protection from the reduced break-even on the trade, but also offers the lowest return. These contracts offer the highest probability that the option will be exercised on or prior to expiry, meaning there is a greater chance you'll have to forfeit your shares. At-the-money calls allow you to take advantage of the greatest time value possible, but offers no further capital appreciation, while out-of-the-money calls offer the lowest premiums, therefore the least amount of cash flow, but also offers the largest potential for the underlying stock appreciation. And what about month selection? How do we choose? Options that expire sooner have lower premiums, potentially higher annual returns if you can consistently roll them over, and lower levels of protection. Options that expire later have higher premiums, lower annual returns, and higher levels of protection. There is no one-size-fits-all solution when it comes to strike or month selection. It all boils down to your desired income and capital appreciation goals. If it feels right to you, that's what matters. Thank you for watching, and happy trading.